I welcome you all to this first session of the 4th East African Banking and Microfinance Forum 2021. The session focuses on the East African banking sector, the structure, performance, and recent developments. I must really thank the organizers of this event, the Trade and Development Bank, in collaboration with EIB, for putting together a very relevant theme for this year's forum, gearing up for recovery and growth, building a more resilient banking sector. While I'm pleased to applaud the resilience demonstrated by the banking sectors in the region, we take note of the fact that the cushions that the regional banking sectors have built over time have been tested and found largely not wanting. For instance, the strong capital and liquidity buffers in Kenya that were well above statutory limits positioned the sector well to carry the rest of the economy as the sector ensured a success of some of the emergency measures that were deployed to mitigate the effects of the pandemic on the households and businesses. The sector's shock absorption capacity and its responsiveness has been tested, and now we can write our resilience story with much more clarity. Nonetheless, we acknowledge that building more resilience is definitely a welcome idea as you consider the recovery of the economy, even with the pandemic still not yet contained. At the moment, an exploration of financing options to augment the bank finance and help share the risk introduced by the pandemic through its disruptions on economic activity continues. The discussions in this forum will center on the important mitigations the financial sector can introduce going forward as we struggle with the COVID-19 recoveries. Concerns at the moment that continue to shape discussions on economic recovery include the slower than anticipated pace of vaccinations, particularly in developing economies that may delay quicker recoveries, accumulated debt from the government interventions, and its sustainability going forward, and the effectiveness of the policy measures deployed as mitigations during the height of the COVID-19 infections in 2020. In this panel session, we will be discussing the macroeconomic effects of COVID-19 on economies of the region and the anticipated challenges to the banking and financial sector, the challenges with debt management going forward. This session that embodies a very distinguished group of panelists drawn from practitioners in banking and development partners will speak on the best case scenarios, economic projections, and the role that banking and financial institutions are undertaking to mitigate the economic shocks in the region to aid recovery. I'm pleased to introduce to you our panel of eminent professionals, experts to handle the subject matter. The first is Mr. Julius Alego, who is the Chief Executive Officer of the Kenya Institute of Bankers, Dr. Joseph Atta-Mensah, who is the Principal Policy Advisor, Macroeconomic and Government Division of the UN Economic Commission for Africa, Mr. Yasin Ibar, the Chief Executive Officer of the Somali Bankers Association, Dr. Felista Kivisi, who is an advisor, Sovereign Finance and Debt Management, Trade and Development Bank. And then we have got Mr. Wilbrod Humphreys Owor, who is the Chief Executive Officer of the Uganda Bankers Association. And finally, last but not least, we have got Mr. Ricardo Santos, the Senior Economist at the European Investment Bank. And starting with Mr. Ricardo Santos on the macroeconomic effects of COVID-19, my question to you is that the pandemic did present some macroeconomic disruptions that had some implications on the banking sector. Kindly provide us your perspective on this, particularly highlighting the pandemic's effects on trade and cross-border activity for countries in the region.
Thank you very much. Good morning, everyone. Thank you, Mr. Habil. Good morning, everyone, and it's good to be back to this forum, hopefully next time physically again, if circumstances allow. To answer to your question, I mean, I had prepared some remarks on the findings that we had from our Banking in Africa survey. That will, hopefully at the end, I mean, it's going to be a short presentation. Hopefully at the end, we'll shed some light on the impact of COVID and what the banks told us that were the impact of COVID on their activities in the continent and then specifically in East Africa. We are almost like pre-releasing here our survey. We're taking this opportunity to do it. So it's a 6th edition of our publication previously called Banking in Africa. Now we expand the publication to Finance in Africa because this time we cover private equity, microfinance, and of course the banking sectors. And we took the opportunity to increase the sample of our survey. Now we have this time around 80 banks that cover all the sub-regions across sub-Saharan Africa, and we asked the banks some questions about digital and green. So to what extent did COVID change their investment perspectives there, and what are they going to do next? Starting with the general impact of COVID on banks across the continent, we see that basically the banks, they report that the biggest impact was on asset quality, as you can see there on the chart on the left, with basically almost 50% of the 80 banks that we surveyed across the continent saying that they had decrease in asset quality due to COVID. But then also lower demand and higher risk to new lending were reported, but to a less extent. In any case, it's remarkable to see that the financial sectors across the region were resilient given the size of the shock that they faced. And why was that the case? Well, we can see that on the right. Banks relied on moratoriums and restructuring of existing loans. I mean, 80% of the banks surveyed, but also they decreased a little bit lending by tightening the standard. And last but not least, definitely, they use guarantees from governments and IFIs to continue to provide credit to the economy. Going forward, and this already starts to answer to your question, we see that most banks across all the regions in the continent, and specifically in East Africa, and I'll go that later in the presentation, report they expect higher demand from loans, both domestically and abroad, for SMEs and corporates, and they are also ready to expand operations. Then on green, it's a special chapter that we have in our publication. We also asked a few questions on banks on green finance. Well, we see that 80% of the banks already embed climate risks into their analysis when they assess new clients or new projects, and 50%, as you can see there also on that slide, on that chart on the left, either already do or plan to introduce climate risks in their own pricing. And then finally, they also expect to provide some technical assistance to clients to better cope with climate risk. I mean, this is relatively important, given taking into account that the realization of climate risk is relatively recent, and we see also that 61% of banks across the continent see green as opportunity. However, there are some constraints to assessing climate, and we see that on the chart on the right. And it's basically the fact that the most important one is the fact that clients are not there and do not require climate risk assessment by the bank. So this ties in with what we have on the left, that maybe it's time to provide more technical assistance, not just to banks but to clients. Then shifting to digital. We also, in East Africa, the first thing is that it was by far the most advanced region in sub-Saharan Africa in terms of digital adoption, and not just in Africa, but even when comparing with other regions across the world. We see that across the continent, 90% of banks expect that the introduction of digital technology and digital processes that took place after the pandemic is likely to be permanent. So this is not just likely to be a one-off, but is likely to be a permanent shift. But then it's interesting to see, as we have there on the top left, that 77% of the banks surveyed say that digital was used to improve customer experience rather than to attract new customers, which then only roughly 50% of the banks reported. So it's more to change the current business rather than to jump to new markets. And then we also asked the banks what are the constraints, so why they don't invest more in digital and what's keeping them to do more. Well, the biggest constraints are actually not funding. It's interesting. It's more cybersecurity, so in risks to security. And then also, and this is to more than 70% of the surveyed banks. And then more than 50% of banks reported IT infrastructure is a constraint. So there is some, well, at the end of the day, these things require investment, and investment requires funding. But it's not now the immediate impact of funding that is driving them, that it's keeping them to invest more in digital. Then shifting to East Africa and going specific to the panel. So starting very shortly on the macro, we see that East Africa was amongst the best performing regions in the continent. It overperformed Sub-Saharan Africa in 2020 and 2021, and is expected to do so also next year, although the risks are mounting given the increase in commodity prices, right? I mean, the lower commodity prices were beneficial for East Africa vis-a-vis other regions, but now this increase in commodity prices means that this IMF forecast might be taken with a little pinch of salt. And then you see also in the right, what is the biggest risk to medium term, or in some countries to short term, which is the mounting increase in government debt. That was already taking place before the pandemic, to be fair, but then of course the impact of the pandemic and all the government support measures that needed to be in place led to an increase in debt, which is now at the highest level since the debt relief measures in early 2000s. And in the case of some countries, it has been an issue. Of course, the short to medium term financing needs were covered either by the IMF programs, by other development partners, or by resorting to some sort of bank financing in the domestic markets in some countries. So there are no liquidity issues, but there is an issue of sustainability that will have to be solved with growth in the future, and the financial sector is relevant here, but then also with financial consolidation. So deficits will have to be reduced over the next few years across the region. And then what does this mean for the financial sector? We see, as I was mentioning before, for the continent as a whole, that the financial sector is sound, as if we take into account the capital ratios in a few selected countries. Of course, there are a few differences here and there, but they are still significantly above what is, the minimum requirements. However, as you can see in the right, NPLs were actually in some countries on the rise even before the pandemic, and they are likely to continue to be in the future, because although growth is likely to recover, although to lower levels than before the pandemic, the support measures that were implemented by the governments and by the central banks are now being removed, and therefore the asset quality is likely to deteriorate, and all the restructurings and moratorias could become non-performing loans. And then on top of this, we all know that there is a lag between economic activity and asset quality, and we are now likely to start feeling the impact of the slowdown and the recession. And then last but not least, also what we found out from our survey in banks in East Africa. As I was mentioning before, and this is even more prevalent in the region, 70% of the banks plan to increase funding and expand operations over the next year, namely in local currency. And 80% of the banks expect higher demand from SMEs. So although the pandemic had a significant impact, and as I was mentioning, banks fear a deterioration in asset quality, the prospects for activity, both domestically and abroad, are relatively bright, taking into account the big economic impact of the COVID-19 pandemic. And before closing, I would just like to say once again that our report will be out in a week, in the 18th of November, and I would, sincerely ask you to go to our website. This presentation will be shared with all of you, and to download and come back to us with any questions. And now, handing over to Mr. Habil and to the rest of the panel.
Yeah, thank you very much. And that's a good point at which we can now call in the bankers. You have given us a very good overview of the macroeconomic effects and how it affects the banking sector. And on this, therefore, I would like to now draw in the bankers in the room. And my question to them would be the fact that the COVID-19 must have presented some challenges in the banking, regulatory frameworks, and compliance in the region. And if we could start with the representative from the Uganda Bankers Association, Mr. War, from your specific market experiences, could you just give us a flavor of your perspective on the developments in the compliance and regulatory frameworks? You can touch on the bank capitalization and restructuring during this pandemic period. But more importantly, you could also give us some flavor on what role the financial and fiscal policies deployed during the period played.
Thank you very much. Thank you, Habil, and good morning to all our listeners and colleagues on the panel. Yes, nobody saw COVID coming, and it's been a roller coaster impacting all the sectors. But the central bank here was quite quick to provide the measures as they've been put across in terms of credit relief measures by way of restructures, moratorium, which have largely ended in September. Some of the sectors have struggled a little more. For example, the education sector that has been closed until now. So cash flows have been a challenge since there's no school fees. And also the hospitality sector. What we have done since then is to sit and say, these hardest hit sectors, how can we extend additional cushion, perhaps for another 12 months, hopefully as they open up, they recover. But beyond that, we have put across proposals for a revolving fund for a slightly longer period. So in terms of compliance, what the central bank has done is to ensure that the financial institutions step up credit reviews. They have given us a heads up on additional paid up capital requirements. They're raising it to almost $42 million from the 10 for tier one financial institutions. We're also having discussions on more guarantee frameworks. Remember, because the sector hasn't been lending, we are seated on a lot of liquidity as well. And yet we are keen to see economic activity be stimulated back to support the growth. On a fiscal side, government has provided some deferrals in terms of tax payments, waivers in certain cases, obviously because businesses struggled, just to help them recover in this particular period. They are also putting together a fund for small businesses, which they've asked financial institutions to join, just to support the SME sector, which, as you know, in this part of the world, is what keeps all of us busy and forms an important value chain, of course. But we can't pretend that the risk of non-performing loans is huge. We have restructured first time, second time. We now have third restructures. And of course, when sectors continue to remain closed, it's even riskier. That remains a worry. And of course, financial institutions are now looking to other revenue generating areas, which is the non-funded income from an activity-based point of view. And that's where the promotion of e-channels is big time. You may want to say there were some positives in COVID. Suddenly the uptake of digital channels really came up quite high. And like the research showed, we're hoping that these customers will stick to digital channels more and more ever. But I think what I should say is this is a problem that started as a health problem. It is now translating, and the way the problem is translating or moving to the financial sector. I think that we must work together ourselves, government, businesses, to tackle it. And I think that there are ways in which we can do this. Recovery may take a little longer, but I think if we put in more guarantee frameworks, revolving funds that typically don't go through the type of stress that commercial banks go through, ultimately we should be able to overcome this. We're also seeing a lot more vaccine uptake. We've received in our country a lot of donations for vaccines. And so what's happening now is across both government and private sector is saying, please go and take the vaccine, go and take the shot. The economy can only open when as many people as possible are vaccinated. So hopefully this message will resonate in the medium term to see recovery take shape. Thank you.
Thank you very much, Wilbrod, for that. And now we can move over to Kenya, and I'll call upon Mr. Alego. Now, Mr. Alego, as KIB, what do you see as the current trends in compliance and regulatory frameworks in the financial services sector? We have heard of the developments in Uganda. Maybe you can contrast with what's happening in Kenya and tell us how they are impacting banking and possibly the KIB's response to this.
Thank you very much, Dr. Olaka, and to all the panelists and all the other people who joined us. It's a great opportunity and pleasure for me to be part of the panel to discuss these very, very important aspects. I think we'll build up on what Wilbrod had mentioned there, broadly speaking, that indeed the pandemic has impacted the financial sector. And coming home, particularly the banking sector, has had its own share of impact. But then I think, to me, what is coming across quite clearly and building up on the presentation we had by Ricardo Santos earlier is that aspect of asset quality, that deterioration of asset quality. And I think this then just brings up a major opportunity for an institute of ourselves as well to work with banks in terms of ensuring that we come up with innovative ways which then we can help address some of these challenges which are emergent and are also, in my view, going to then build resiliency in banks particularly. I would also just want to address myself to, I earlier had the opening remarks by Dr. Ndungu, who mentioned that perhaps one of his 4 critical areas for the past pandemic is to protect, regulate, and of course, develop markets. And I think key for me there is, yes, developing markets is absolutely good, but then there is that key aspect of compliance, and this comes in compliance with the regulations within the banking sector. And I think it brings out a very, very important aspect for us, because from the pandemic, if you have to look at it, what have we seen? We've seen that there is that huge increase in alternative delivery channels, the uptake of alternative delivery channels. And with that brings out the inherent risk, rightly again, as brought out by Santos earlier in his presentation. And this is around cybersecurity. This is a key area that we, as the Institute of Bankers in Kenya, have addressed ourselves to. We've in the recent past been coming together and ensuring that, since this is a systemic challenge in the market and across the world, and hopefully we can only mitigate it if we work collaboratively as the financial sector. So one of the key aspects that we are pushing and addressing ourselves to is to ensure that our interventions are across different institutions. This calls for a lot more of work, because, as you'd imagine, with a lot of commercial interest within individual institutions, that aspect of collaboration becomes very, very difficult. However, the reality is that cybersecurity brings out all this risk, and we need to work together in terms of alleviating it. I think, just in conclusion as well, I see myself looking at it, broadly speaking, in terms of compliance and regulation within the banking sector as well. That there are a number of things that are coming through. Of course, COP26 has brought out the aspect of responsible investment, looking at ESG, and I think it's an aspect that, if banking sector, particularly in Kenya, are addressing themselves to, and as an institute as well, we would want to work absolutely very, very closely with financial institutions to build those aspects and that compliance to ensure that we are bringing out the aspect of responsible investment quite clear. And then there is data protection, following through with the GDPR. And the Data Protection Act is a key element for us. We cannot gainsay it. I mean, this to us is going to take a much bigger role in terms of compliance as well. And I think from a regulatory perspective, we need to be out there to just talk to banks and ensure that we are up to speed in terms of aligning our own frameworks to adhere to this very important regulations. I think, broadly speaking, and back to you, Dr. Olaka, and to the other panelists, I'm seeing the trends in compliance and regulatory framework changing up very fast, and the pandemic, if anything, has accelerated that pace. And we, as the Institute of Bankers, are right at the center of this to try and help the financial institutions to mitigate this. Thank you very much.
Thank you very much, Julius. I was actually going to ask you, what opportunities do you see for KIB there?
No, thank you. Immense opportunities. And I think, if anything, the greatest opportunity is in collaboration. And I'm happy that we are in this forum with other speakers and other panelists who are absolutely great experts in their own areas of specialization. So if anything, this is a great opportunity for us to ensure that we tap from different arrays of expertise that are within different aspects. So thanks a lot, Dr. Olaka.
Thank you. And then with that, let's move over to Somalia, where we have got the Chief Executive Officer of the Somali Bankers Association, Mr. Yassin Ibar. And from him, I think I would like him to give us an update on what's happening at the Somali Bankers Association and the challenges that you're facing locally in Somalia. Over to you, Mr. Ibar.
Thank you, Mr. Olaka, for the question. And I will start with your question. But before going through it, it's really a great pleasure for me and the Somali Bankers Association to be here and participate in the East African Banking and Microfinance Forum. And I want to take the opportunity to thank the Trade and Development Bank and the European Investment Bank, as well as the organizers, who put a very hard work for this forum to happen. And it is very insightful discussions, sessions, and I hope it will bring solutions into the financial sector. And for quick briefing of SBA and recent developments in Somalia during the last few years, is the first one. The Banking Association here in Somalia have now 11 member banks, which mostly are infant and recently established. And we are hoping 2 more are coming to join the association and the banking sector in Somalia at the beginning of next year. Therefore, the financial sector in Somalia is gaining interest from development organizations, including the World Bank, the IMF, investors, the regulators, and many trainings have been provided in respective sectors. And much has been invested in developing regulatory frameworks by the Central Bank of Somalia and establishing the Financial Intelligence Unit, known as the Financial Reporting Center, FRC, in Somalia for a few years back, and developing the